Now, as we pivot into what comes next following that July 4th bump, you can see, and we always like coming back to this chart, because you can see in 2021, we also had that nice bump up. We had that normal flow, and you can see that it typically happens in 2017, 2018, and you get that shift in that pivot. We just see it following something similar to 2021, where you get that spike up. It's going to come down a bit. We don't see the drop as extreme as it was in 2021 because there were so many issues which were very unique to last year, which was trucking shortfalls. You didn't have the drivers. You didn't have the ability to get the gasoline to where it needed to be. So you had these really lumpy moves. Things are a bit more normal this year. So not to say that we still don't have our problems, but that's why we don't see the same extremes, and we expect this to come down. When we're looking at the total number, we expect it to come back below 15,000, but remain fairly stable at those levels, but just moving in an upward trajectory as we normally do going into the August month. So when you look at the current demand is 15.764 million barrels a day. Last week was 14.508. So again, you had that big step up that was driven by gasoline and diesel, and we expect each one to come down, but not to the same level, which is why when we're looking at this, it's like we're not coming to 14.5, we're coming to 14.9, maybe 15, and that's where you're not staying at this level. So you are going to lose some demand, but it's not a drop off. Like as we've been saying, demand destruction in the U.S. is not like what we had in 2020. That was a very unique situation where you had that steep drop off caused by lockdowns and limitations. Typically, when you have an adjustment in the U.S., things are going down by 3%. 3% in diesel, 3%, maybe 5% in gasoline. You're not getting these huge drops because there's an income scale. People that look at flights and are like, I'm not flying. It's too expensive. I don't want to worry about it. I'm driving, because realistically, driving, spending $100 on a tank of gas is painful but manageable. But then there's people that $100 for gasoline is devastating. So you'll get that income scale slide, but people still need to go to work. Nurses still need to get to the hospital. Teachers need to still get to school. You're still going to get people moving. So there is some inelasticity in this. There's some elasticity. Again, there's going to be that swing, but there's a floor. And again, that's where we continue to talk about where we sit right now in this market. So then when we start looking at distillate had a draw of 1.26 million, still 30.1 million off the 5-year, but it's all in Pad 1. Pad 1 had a draw of 2.59 million, 21.1 million off the 5-year average. And again, that is where we're seeing the biggest problem. Pad 2, 6.3 million off, but again, that can be they're trying to address that by bringing down the additional capacity from Canada. Pad 3, very normal. Pad 4, Pad 5, same thing. Imports remain elevated, increased by 8,000 barrels a day, but Pad 1 had a drop of 34. So again, we do expect Pad 1 to continue to increase because Pad 1 has the biggest shortfall. So when we look at Pad 1, we should be going up. Again, we never go up in a straight line. There's always this chevron pattern. But as we've been saying, the rate of change has to accelerate. If it doesn't, we're going to be in a very difficult spot come winter, because New England, or Pad 1A, which is Pad 1A, B, and C, as you come down the coast, the East Coast, Pad 1A consumes a lot of heating oil, and that is going to become a big issue, which is why this is going to be the one to watch to see what is that swing when we're looking at diesel production. And again, bringing additional imports in, and how much will we compete with Europe as this additional Middle Eastern diesel comes into the Atlantic Basin. So then when you look at Pad 3, obviously, you can see we're still low, but it's fairly manageable in comparison to where other things are, especially on Pad 1. And if you take out this big surge in 2020, it's fairly comfortable versus the 5-year average. And I think that's where, when you start looking at these extremes, it's pad 1, that continues to be the problem child. Now, on the distillate side, there was a big spike in production. So the production of distillate increased till 32.7%, where when you look at gasoline, and as somebody pointed out, when we talk about gasoline, we're talking about gasoline and its products, just because it's easier to lump everything together, because the show's long enough, we could make it longer. But again, that's where so 32.7% was focused on distillate, about 60% on gasoline. So again, you're seeing that they're still weighing towards and weighting towards as much as they can on the distillate cut. So here, when we look at demand, we had the spike in demand here where we're above the seasonally adjusted average. We're setting new seasonally adjusted highs. But you can see there's the spike and fade. We expect to see the fade. And again, it's not that it's going to be a huge drop, but we do expect to see something closer to that valley that we had, not this past week, but the week before. As we start to get some of this normalcy, we expect diesel demand to be below the 5-year average. But again, not a huge drop, just below the 5-year average, but again, tracking it on a seasonal basis. And here's some of the reasons. So when we look at truck shop market demand, you can see that there was a drop to 85. A lot of that is also including the holiday. So again, we will get some of that coming back. And the reason why we say that is load availability, because load availability actually went up, which again is more of a leading indicator for where market demand is going to be. So it's not that we're going to surge back to 150. It's just we're going to go back to 95, and we're going to stay within this level as we continue to move through the rest of the year. And then when we look at U.S. rail traffic, you can see that car loads are still 1% below 2021. And realistically, grains had a big step up of 15.3%, which is a fairly sizable move when you think about how much grains was driving 2021. But again, grains, motor vehicle parts, those are things that are going to remain elevated. And then obviously coal is going to remain near the highs. Intermodal still below the 2021 numbers, and we as we were saying, we see it holding at this, let's call it 3 to 4% below 2021, but again, still being elevated as things have to move. But we continue to see those slowdowns in terms of cargoes coming through, because remember, we were saying that as China comes back, we're going to see this show up at the end of June, really July though. But as you can see, we see it, and it's there. It's slightly above 2021, but we're getting a fairly steep drop off. And right now, the end of July and August actually look fairly ugly in terms of the amount of imports or lack of imports that we're going to get, which would be good for GDP when you think about exports minus imports in terms of how that calculation works. And it will also help the supply chain catch up even closer, because delivery delays will be a bit faster. But again, this is something that is just showing that global trade shift and some of the pressures that we've been talking about on the econ show. On the weather side, you can see that there still remains a fairly broad heat wave that's striking pretty much all of the south and now expanding into the west coast. Things in the northeast will remain fairly normal, especially in the mid-Atlantic, and then around the Great Lakes, either normal or just below. So again, there's still going to be enough of that pull through for the electricity side, which will be very good for us who own dams and actually sell electricity, and then for some of these in terms of natural gas consumption and just electricity consumption in general. Now, when we look at gasoline had a draw of 2.5 million. When you look at what was the driver, it remains Pad 1. Pad 5 had a small draw of 1.19 million, but still above the 5-year. And so when you look at gasoline and the 5-year average being 22 million below the 5-year, again, Pad 1 is 14.7 million of that. Pad 1 in the East Coast continues to see those problems, which is why when we look at imports increased 120,000 barrels a day from 825,000 to 945,000, and we expect it to be between that around that 800,000 barrel a day on average. We'll drop to 600, we'll go to 900, 1.1, but again, we're going to continue to see that as Europe tries to manage their storage, which continues to rise. And Pad 1 continues to try to backfill. That's again going to pull some of that European product into the U.S. And then when you look at gasoline storage, you can see we're right on the 29-year average. But we expect this to go sideways to slightly up. And when you look at that dotted line on the 29-year average, we typically have a fairly sizable drop in storage as we go through, again, those pivotal 6 weeks. We just don't think that we're going to get the same drop, where instead we're just going to go more sideways, slightly up, not huge, but again, just more sideways, making these comps much easier and closing that gap in general as we see those headwinds on gasoline demand. Just looking at the last 10 years, just to give you an idea, where obviously 2020 was a unique year, but taking that out, we're still low, but not crazy low in terms of where the amount of global gasoline is. There's more in Fujairah, there's more in Singapore. Singapore's hitting a record, Europe's hitting a record. So again, gasoline really isn't the problem here. It's going to remain on the structure, cyclically speaking, but really structurally speaking on the diesel front. So then when we start looking at some of the driving, you can see that congestion in China has continued to improve. You're seeing some of this bounce back, which again is driving some of the Asia Pacific, which is pulling the world level back to normal. But you can see that America and Europe continues to be well off of normal. And then when you look at TomTom congestion, you can see it again moving in the wrong direction and staying fairly below. And that's a comment for Asia Pacific, Europe, North America. So again, we still think we trend just below normal when you're thinking world level. We think that accelerates, especially in July, because for those that have been watching us and watched the different shows, emerging markets have a lot of subsidies that are expiring end of June and July. And, we saw it in Malaysia. We've seen it in Sri Lanka. We've seen it in other nations. And we expect that to, again, hit on where we see some of these pressure points and a drop in demand. In the U.S., you can see that gasoline prices continue to roll over. Now the national average is $4.75. One of the things that we've been saying is that gasoline was going to continue to fall back to about $4.50, but not diesel. We expected diesel to be at $5.50 and really hold there. And right now we're at $5.69, $5.70. So that we're still going to have some of that downward momentum. But we're still elevated and we're still at a record. So again, diesel's the one that is going to be that tailwind for inflation while gasoline comes down, and that'll act as a headwind. But again, it's just going to be that push and pull in terms of the different situations. When we look at blending components had a draw of 3.06 million, 17 million below the 5-year, but a lot of that is driven by 2020. So when you look at the average, we're very comfortable right now in terms of blending components, and that's going to continue to be the case as we just don't see the same demand in gasoline. And now, speaking of good demand in gasoline, going back the last 10 years, you can see that there's normally this spike right now, and you can see it in 2014. You can clearly from that light green line. But again, we expect it to come down. We should see a peak. Like when you look at 2021, this week was the peak, and then it came back down. This should be the peak for the year. And we expect that to be the case and come down and again stay elevated, but not at the same rate that we have in the past. And here's where we're seeing it show up. Obviously, workplaces came down, retail, recreation, everybody went to parks. So again, you can see just the normal movements continue to be there, but the total driving continues to be fairly lackluster. Propylene had a build of 910,000 barrels. But again, it should be building. So it comes down to rate of change. And when you look in comparison to 17 and 18, we're now setting new lows. And that's going to be the concern as we go into the winter season when propane demand in the U.S. grows. And when you look at days of supply, you can see just how far it's fallen out. And that's going to continue, especially when you look at how much those exports are really increasing and what that means in general. So now when we start looking at the jet fuel side, you can see that there was that spike as there normally is. It still fell short, and we expect it just to pull back. There was a draw of 1.49 million, just 1.7 million below the 5-year. So really nothing crazy in that backdrop. TSA passengers, you can see that this is typically the peak of the year. We normally have another peak as we go into Thanksgiving, as you can see in both those. So this is really the high for the summer, and you can see that it remains well below 2019. We expect it to be above 2021, below 2019, and really just follow those seasonal patterns. And when you start looking at departure schedules, same thing, 0.21% lower than the previous week. Nothing has really changed one way or the other. And then on the open table side, you can see that people do a lot at home. So it's just people are fairly lackluster. So this week will be a little bit slower. But as we go into next week, we want to see, does it bounce back? Because we should see either normal, globally speaking, either normal restaurant activity or 5% above normal. But this could be, is this the start of a slowdown where people are going to eat out less? Or is this just seasonality? Right now, there's not enough data. If I had to choose, I'm going to say this is just seasonal and we'll get a bounce back. But again, that's something that we're going to look at as the next 2 weeks of data comes out.